relative price shock of this geopolitical event with Iran, how does it compare to historical events like the 1970 supply shock or Gulf War One?
Well, so far it's following the script of there's an oil shock, stock prices go down because oil shocks tend to be potentially recessionary because it obviously creates a pinch at the gas pump, and it can be inflationary as we saw during the 1970s. And the market's down about 10% so far. It's week four now. And from here, it depends on how far the conflict goes, right? In 1990, when we had the first Gulf War, oil prices in today's terms actually spiked to 100, but then came right back, and it was really not felt in the market beyond kind of a blip on the radar screen, if you will. But you look at 1973, 1979, those were obviously much bigger shocks. They lasted much longer. There was already an inflationary or a stagflationary circumstance building, and so that caused much deeper drawdowns.
Jurien, when you think about the price of a barrel, and as we're speaking today, West Texas Intermediate trading around $103, $104 a barrel, Brent touching $119 a barrel. We have talked in the past about sort of the relative dangers at different price levels. And when we start getting up to about 120, it stops being just a good thing for domestic energy producers and starts being a pressure point for many different industries. How near are we to that pressure point if these price levels were sustained even just for a few weeks?
So history shows that when the price moves a lot and it moves a lot very quickly, that can be a real problem, right? Because you get the sticker shock, literally. And right now, of course, it's not just oil that's stuck in the strait, but it's other raw materials as well. Fertilizers, potash, helium, which actually is needed for AI. I didn't really know that till I read it
I
recently.
didn't either.
Yeah. Um, and so again, if it persists, it's going to build and build in terms of the problems that will go downstream. Right now, the market is still betting, and by betting I mean if you look at the oil futures curve, the front contract is about $30 higher than let's say contracts, 6, 9 months down the road. So the market is still assuming that this will be a relatively short-lived episode. But for every week that passes and it proves to be not so, the consequences kind of exponentially go up.
You were also a technician, Jurian, and you were looking at price levels. Talk to us about what kind of support levels you think this market has. Is the drawdown close to over?
So the S&P as of yesterday was down 9.8%. The MSCI emerging markets and developed markets indices were down about 12%. So still relatively modest. And the reason why it's modest is because earnings are not only very strong, but they're actually accelerating higher. That was one of the biggest takeaways I had from looking over all my charts over the weekend. And it's not just that the energy companies are seeing their earnings revisions go up. I mean, they are, but the energy sector is only 3 or 4% of the market, so they're not moving the needle that much. So we are in a solid mid-cycle expansion in the US and many parts of the world, and earnings estimates are actually accelerating higher. And the reason that's important is because it masks what's otherwise would have been a much deeper correction, right? So the S&P 500 PE ratio is down about 18, 19% from its high. And if earnings were not growing as much as they are, we would see the price index, well into the double digits. And it's not because we're in a very strong fundamental environment, at least for now. And when I look at the charts, S&P, we were well above the rising trend line. Now we're at the trend line measured back to, the last 10 or 20 years. And we're approaching the previous high, which was the high before the tariff tantrum last year, and that's at around 6130 for the S&P, and we're about 6300 at least as of yesterday. So we're not quite there, but that would be strong support in my opinion. And in the meantime, you look at relative strength, momentum, breadth. They are moderately oversold, but they're not like crazy oversold where you can just really have a lot of confidence that the market is so washed out that you can take the other side. So we're not quite there yet.
The Mag 7 having a strong drawdown effect on us. How disproportionate is the effect, the downward pull of the Mag 7 right now?
Yeah, so the S&P 500's down, 9-10%. The Mag 7 is down about 17%, and the equal weighted S&P is down about 7%. So it shows you that this is a cap heavy drawdown, and the Mag 7 did sort of fall out of its range that it was in for the last 4 months. And we've talked about this many times. Concentration risk is a real thing. When the top 10 stocks are 40% of the market, if they go down, the indices are going to go down, even if the market is broadening. And it certainly was broadening before this event. And it was a very, robust broadening where the market actually stayed up as more stocks participated. During times of stress, as I'm sure you know, correlations tend to converge on one, and that's certainly what we've seen. But I suspect once this episode, this conflict is over, the trends that were in place before will resume.
You mentioned that you think the Fed model may be taking hold again, and that equity prices. First, describe to us what the Fed model is and why you think it is here again.
Yeah, so that was another takeaway last week, and that is that the 10-year yield spiked up to 4.48%. It's down to 4.33 right now. But for many years since really the financial crisis until the rate reset a couple of years ago, bond yields were so low and they were so dominated by central bank policy that they didn't really harm the stock market if rates went up. But that is sort of the exception rather than the rule. For many, many decades, from the 1950s to the 1990s, we had this phenomenon, and Alan Greenspan kind of popularized it in the 80s, called the Fed model, that if what we call the risk-free rate, so treasury yields, are competitive with the yield on stocks, and the yield on stocks is just the inverse of the PE. So when the safe asset is competitively priced against the risky asset, then if that safe asset goes down in value, so meaning the yield goes up, it forces the risky assets to reprice in order to remain competitive. And so again, when yields are 1 or 2%, doesn't really matter. But when they're 4.5, 5%, and the S&P is yielding the same, the stock market has to pay attention and it has to reprice. And that's called the Fed model. And so that's something that I've been focused on since 2022 when we had that rate-driven bear market. And again, one of the circumstances of this conflict in the Middle East is that it has pushed yields higher, not just in the US, but around the world. And that, could impact valuations for all equities if it continues. And as I always like to say, nothing good happens above 4.5%. And we got awfully close last week, but we're down a little bit today.
Jurien, it's a pleasure as always speaking with you and having you on our show. Tell us, please, where we can follow you on social media and where we can get your weekly asset allocation review, which is just brilliant.
Thank you. I write that every Sunday. By the time it gets on LinkedIn and X, it's usually Tuesday morning. But you can see my entire stream of consciousness there in terms and including all my charts. And we also post during the week, and there's a bunch of podcasts on YouTube as well.
And that's Jurien Timmer, Global Head of Macro at Fidelity. Thank you, Jurien.
Thank you.
Bye bye.